Hi there, as part of our revision for EdExcel, Unit 3 Micro, let's take a look at the economics of the Private Finance Initiative, or PFI for short. So this is the EdExcel A2 Micro Unit 3 content list. There are essentially 11 topics that you need to nail for this exam. I'm sure you're well into that for revision for 2016. PFI, of course, is a controversial policy designed to change really the model of funding for large-scale, bulky investment projects. And it appears in several sections of the syllabus, for example, efficiency, the relative efficiency of the private versus the public sector, and crucially also, why does the government intervene in markets to maintain competition? For the exam, you'll need to be aware of the various types of private sector involvement in public sector organisations. So contracting out, for example, is when local authorities contract out hospital cleaning, laundry, or school meals to a private sector provider. Lots of organisations are involved in sort of competitive tendering or outsourcing of services, giving the private sector a chance to provide them. So, for example, there are two very big businesses that provide sort of outsourcing services, winning competitive tendering services. Serco is one. They do services such as air traffic control and border control and commuter transport services. Very big organisation, Community Care. G4S you may have heard of, they're a big outsourcing company. They helped or tried to maintain security at the Olympics in 2012. They do lots of cash transfer, monitoring of prisoners from court to prison, etc. One of the big aspects of this is the Private Finance Initiative, PFI, and this is going to be the focus of our little video today. So the PFI is basically a model for big-scale capital investment projects. First launched over 20 years ago by a Conservative government, very heavily extended by Labour, and in fact the peak year for the Labour PFI, you can call it commitments, other people will call it a fetish, was 2008, as we'll see in a second. By 2011, hundreds of hospitals and schools, prisons, road bypasses, widening schemes, social housing, lots of PFI projects had been built under PFI. The idea is that the private sector invests to build and then manage public infrastructure, new schools, new hospital, new prison, for example, and the government pays for it. The private sector comes in and provides some finance initially to finance the construction, and then over a 20, 25, 30-year period, the government pays back the value of the contract, including annual service charges for the maintenance of the project. So under PFI, the government takes competitive bids for and then buys an investment package. For example, the design, the construction and the delivery of a new hospital. The package typically involves construction, services and maintenance. So essentially a vertical project. And the government pays back the cost of the whole project over a set period of time. Looking at the data, as we can see here, the key peak year for the capital value of PFI projects agreed in any given year was in 2007-2008. Nearly £9 billion of projects agreed just in that 1 year. Now notice, since then PFI has tailed away. PFI has become less popular, in part because of the financial crisis 2007-2008. The banks started getting very nervous about how to fund it. So here's a good example of a PFI project. One of the most recent ones and one of the most significant ones, a new children's hospital in Alder Hey, Liverpool. Over £160 million project, state-of-the-art hospital for children, paediatric care, significant PFI project. One of the biggest children's hospitals in Europe has been built under PFI terms and conditions. So what's the argument for PFI? Well, the argument basically is that the private sector is a better, more efficient provider of public services. So the argument is that if you have a fixed term contract for building, let's say, a prison or 1,000 new homes, or building and then running a new motorway or bypass in a town, if the private sector has a fixed price contract, then they have every incentive to stick to the contract and be productively efficient in the allocation of resources. So that's the first argument. The private sector is possibly more productively efficient. Of course, that's open to debate. Secondly, the green point here, that the extra investment actually fast forwards much needed long-term investment. We need better housing, we need more up-to-date schools and hospitals, we need wider roads, etc. And bringing the private sector in is a way of helping to fund much needed capital expenditure, which could both have a social welfare effect for consumers, and also a macroeconomic spillover as well. In terms of delivery, the private sector is not paid until the asset's been delivered under fixed price contracts. And the wider argument, it's not just about productive efficiency, it's also about dynamic efficiency, that if you bring together a consortium of experts, private sector firms, be in logistics, construction, design, engineering, etc., these are nearly always consortia that win these projects, then they can work well together, and there can be some spillover effective ideas and good practice, and that improves innovation. For example, innovation in building new homes, affordable homes, or innovation in building new schools. So in my local town in Harrogate at the moment, there's a new school being built. I'm not sure if it's PFI or not, but they're building it really quickly, and most of the construction has actually taken place off-site, and they then bring the completed modules to the school site and just lock them together with the use of one very big Allen key. There are, of course, many criticisms of PFI. So PFI is a controversial strategy for the government getting involved in markets. The debt costs can be significant. So typically the private sector, when it borrows from the markets, it borrows at a higher rate of interest than the government could borrow at. So let's say the private sector could borrow at 6%, maybe the government at the moment could borrow for 10 or 20 years at 2%. So actually, in theory, it makes more commercial sense for the government to be funding these projects and borrowing the money. Oftentimes these contracts are pretty inflexible, very difficult and costly to change, and they don't necessarily deliver value for money, as we'll see in a few minutes. Ultimately, the risk with these projects still lies with the taxpayer. If the business or the consortium that's delivering the project goes under, then it's up to the taxpayer and the government to foot the bill and to bring the project to fruition. So ultimately, actually, the risk is with us, the taxpayer, not the shareholders. And there's a kind of equity and distribution point, which is that PFI has added to public sector debt, but it's created a lot of private sector fortunes. Millions of pounds have been made by construction companies winning projects, and consultancy companies trying to sell their services to, so we say, slightly gullible local authorities and government ministers in particular. Okay, so one or two examplos. Crossrail is a tremendous project, I think, in many, many ways. Actually, it's a mix of public and private sector finance. On time, under budget, big success, I think. Crossrail 2 is probably likely to happen quite soon. However, that said, the government has decided not to use PFI for the rolling stock, for the actual trains and the carriages themselves. So they've decided not to use PFI. Eventually, they've awarded the contracts, the main contracts, to a Canadian company, Bombardier, who I think is going to build the Crossrail rolling stock in Derby. So they decided not to use PFI for that one. More recently, just this year, the Edinburgh PFI controversy with schools, that these schools, 17 schools, were shut down after substantial building faults were discovered. There's a picture there for you to look at. And these schools were built about 10 years ago. They're not new schools in that sense, but they were built under PFI projects. And there's a criticism here that these schools were built fairly cheaply and not necessarily with the best, most rigorous safety design built into the architecture. Shoddy workmanship, poor materials, etc. And now, of course, there's a major cost in terms of getting these faults rectified. So you can argue this is a false economy, PFI, a false economy. And the NHS is a good example. Lots of new hospitals have been built under PFI, no question. We mentioned Alderhay Children's Hospital. So we've had some significant NHS building under PFI, something that Labour was very keen to trumpet in its years in power. But actually the total cost over the lifetime of a contract for these projects is way above the actual construction cost. And this would be a key valuation point to make in an essay, that the total cost of the deals in England for hospitals is just under £12 billion. But over 31 years, they'll cost £80 billion to pay back, £4,000 per household in Britain. And a lot of construction companies have made some serious money from these kind of PFI projects. Here's a nice quote to finish with from Michael White in The Guardian, hinting that PFI is a source of government failure. PFI gets stuff built, but badly negotiated contracts in the past, and these can stretch back 10, 15 years, have left schools and the NHS budgets carrying long-term costs in some instances. Not always for the right sort of building either. Overambitious IT projects, Thames Garden bridges in the wrong place, and lobbyists and contractors trying to sell flash schemes to ambitious, susceptible ministers and officials. In other words, government failure in terms of the awarding of contracts. Don't know who those two guys are in the right hand corner, and in a week's time nobody will know who they are. Possibly. Okay, so that's been a quick revision session on the economics of the Private Finance Initiative. Thank you.